Welcome back to the class Investment and Portfolio Management. This week is week 3. There are two subtopics of week 3. The first subtopic is as shown on PowerPoint 3.1, that is financial market. However, in front of you is the second subtopic of week 3, as shown on this PowerPoint 3.2. Financial security. What I expect from students when you complete the topics of financial security. Firstly, I expect students can identify financial security of each financial market. Second, I expect from students to describe the characteristics of each financial security should be the second learning objective. As a result of learning objective, I will share you the knowledge about what are financial security, what are the debt security, in another word is fixed income security. What are the equity security, such as common stock, preferred stock, and warrants? What are the derivative securities? We will start with the financial security. What are financial security? What do you think? The financial securities are financial instruments that hold some form of value and can be traded in the financial markets. Financial security can contain the right to receive future cash flow. The future cash flow may include discount if you invest in some treasury bills, coupon, or interest if you invest in government bond or corporate bond, as well dividend if you invest in stock equity, right, as well as capital gain or loss from investing in financial securities. The key laws of financial security are, for example, firstly, to facilitate capital raisings for private sector or businesses and for governments. Secondly, to facilitate saving and wealth creation for individual investor. Third, to enable investment opportunity for both an institutional investor and individual investor. Fourth, to promote liquidity for investors who want to buy security, as well as liquidity for investors who want to sell those securities. Last one, to provide diversification of your investment portfolio. The common types of financial security are here as fixed income security or debt security, equity security, and derivative securities. From slide number 9, I show you the categories of financial security. Please notice that the money market, government bond, and corporate bond are categorized in the fixed income or debt security on your left-hand side. In between, right, the equity security, common stock, preferred stock, and warrants are categorized in the equity security. On your right-hand side, please notice that futures, forwards, and options are categorized in the derivative securities. Shall we start with fixed income or debt security? What are debt security? What do you think? Here you are. Fixed income or debt security is a kind of loan that borrow who may be government or companies borrow money from the lender. Who are the lender in this case? Lender can be you as individual or retail investor, can be institutional investor as well as foreign investor. For the fixed income or debt security, the borrower need to pay periodic coupon or interest and principal on the maturity date. The lender will receive periodic coupon or interest and principals on the maturity date. For example, please imagine that Siam Cement Company Limited issue a debt security for 5 years at the beginning of the year 2026, for example. Here, Siam Cement commit to pay coupon or interest 5% per annum, semi-annual, or every 6 months. Please imagine that if you are the investor who invests in this Siam Cement corporate bond, you invest 100,000 baht in debt security of Siam Cement Public Company Limited at the beginning of year 2026. Then at the end of June, that is a 6 month, right? At the end of June 2026, you will receive 2.5% or 2,500 baht and another 2.5% or 2,500 baht at the end of December 2026. Siam Cement will repeat this coupon payment on year 2, 3, 4, and 5. At the end of year 5, Siam Cement will return you your principal 100,000 baht. The first type of debt security or fixed income security is money market security. What is the characteristic of money market security? Firstly, high liquid. Second, low risk. And the last one, that is the short term, less than 1 year. Well, in terms of high liquidity, that is the main characteristic of the money market security are high liquid. What does it mean, high liquid? High liquid means you or the investor can sell or change this security into cash rapidly. Low risk. What does it mean, low risk, in terms of the characteristics of the money market security? The money market security contains low risk compared with other debt security and other financial security. The third main characteristic of the money market security is the short term, that the time to maturity less than 1 year. The main money market instrument in the real world should be Treasury bill or T-bills. What is the Treasury bill? Here you are. A Treasury bill is a kind of short-term government debt. I mentioned government debt. What does it mean? It means that the treasury bill need to be issued by government. The treasury bill is backed by the Ministry of Finance. Because the treasury bill or T-bills is backed by Ministry of Finance. The T-bill is a kind of the risk-free asset as well, and the maturity of T-bill or treasury bill is not more than 1 year. I summarized you the characteristic of treasury bill here on the slide number 17. Firstly, maturity date. As I mentioned in the previous slide that the maturity date of the treasury bill should not more than 1 year. Second, that is the sold at discount rate. If you expect to buy or invest in treasury bill or T-bill, the T-bill will not pay you any interest. How the T-bill pay you the return? What do you think? Here you are the T-bill will sold at discount rate. What does it mean, discount rate? Discount rate means to buy the T-bill at the beginning of the year at the price saying 973 baht. At the maturity date, it might be for the next 3 months. The issuer or the Ministry of Finance will return you the full amount of 1,000 baht. Third one, sold as a form of zero coupon bond. As I explained you in the previous item, sold at discount rate, right? As a result of the discount rate, the T-bill or the treasury bill sold as a form of zero coupon bond. Zero coupon bond means the Ministry of Finance will not pay any interest. Interest in another word as investment technical term is coupon, right? As I share you in the previous slide. Fourth one, sold by the Ministry of Finance. The T-bill or treasury bill should be sold by Ministry of Finance, right? Not any bank or not any company or corporates. Third one, risk-free asset. Because the T-bill or the treasury bill is backed by the Ministry of Finance, then the T-bill will be a kind of risk-free rate. At this point, we finished the treasury bill, that is the money market securities. Bonds. Bonds are fixed income or debt security. What are bonds? A bond is a debt security in which the issuer, like Government of Thailand or Siam Cement Public Company Limited, who is the private company or the private sector, right? These issuer borrow funds or money from investor. The issuer promised to pay the bondholder the face value as a principal at maturity and periodic interest payment or coupon. The bondholder means investor. It might be retail investor, individual investor, or institutional investor. The bond allow government or corporation to raise money as loan from public or investor. There are two main types of bond that are first one, government bonds. And second one, that is the corporate bonds. What is government bond firstly? In terms of government bonds, what is government bond? What do you think? Here, government bond is a kind of debt security or fixed income security that issued or launched by a government to support the government spending. And sold to the investor, it might be the individual investor like you, right, the students, or might be the investor can be the institutional investor as well. The main characteristic of government bond is firstly, pay periodic interest payment. Government bond will pay you as the bondholder or investor periodic interest payment. What are the periodic interest payment? The periodic interest payment is the payment as a period, for example, every 3 months as quarterly, or every 6 months as semi-annually, or every year, that is the annually. Second, return the principal at the maturity date. Government bond will return you or the bond holder the principal at the maturity date. This characteristic, as I mentioned in the previous slide as well. Third, low risk investment. Government bonds are considered low risk investment because the government back the government bond. Fourth, pay low interest rate, right? Because of their relative low risk, right? The low risk of government bond comparing with corporate bond. Government bond typically pay low interest rate. At this point, you already have the idea of what is the government bond. We then move to the corporate bonds. What is a corporate bond? What do you think? A corporate bond is a type of debt security or fixed income security that is issued or launched by a corporate or a company and sold to you or to the investor, like an individual investor as well the institutional investor. The main characteristic of bond are here. Pay periodic coupon or interest, return principal at the maturity of that bond. Some bonds pay higher coupon or interest to compensate the additional risk. For example, if you compare coupon or interest between 5-year government bond and 5 years corporate bond, the 5-year government bond may pay you coupon or interest at 2%, while at the same time, the 5-year corporate bond may pay you 4%, while corporate bond need to pay higher coupon or interest. What do you think? The answer is that corporate bond is riskier than government bond. Then the issuer of the corporate bond need to pay much more coupon or interest to compensate additional risks of the corporate bond. Government convertible bond as the hybrid financial security. Here, I would love to share you the knowledge. I would like to introduce you to know the convertible bond. We call convertible as the hybrid security between fixed income or debt security and equity security. At the beginning, the convertible bond will be categorized as debt security. But in the later, the convertible bond can be converted to stock or equity security. We call convertible bond as a hybrid security between fixed income or debt security and equity security. The convertible bond provides the right to bondholder to convert the bond to stock equity of that company. For example, can you imagine that Siam Cement Public Company Limited launched a 5 years convertible bond with 3% coupon. This bond allows investors convert this bond to stock equity of Siam Cement at the beginning of year 3 at 200 Thai baht. For example, here. You probably have some questions. Why the investor should invest in the convertible bond? So there is the advantage of convertible bond for the bondholder or to the investor. There are two main advantages here. The first one should be the downside protection, and the second one should be the upside potential. Here, the advantage of convertible bond for the investor or bondholder are here. Right? First one, to protect downside risks. What does it mean? If the issuer cannot perform well, the investor, like you, can hold the convertible bond and receive coupon until maturity dates. If the issuer perform well, investor can convert the convertible bond to stock equity, then sell the stock equity in the market to take profit. That is the second advantage of convertible bond. That is the upside potentials. However, I will share you the idea, the knowledge of the advantage for convertible bond. Here in this term at the slide number 79, that is in the angle of the issuer. It means that the corporate who launched or issue the convertible bond. What are the advantages of convertible bond for issuer? Here, first one, lower interest costs. And second one, deferred dilution effects. As I mentioned in the previous slide, the advantage of convertible bond for issuer or Siam Cement, right here. First one, Siam Cement can offer lower interest costs. In the case of Siam Cement, right, pay 3% coupon for convertible bond instead of 5% straight bond. For the previous example, for the straight bond of the corporate bond, right? If straight bond, Siam Cement need to pay 5%. On the other hand, if Siam Cement launched or issued the convertible bond, the interest or coupon could be 3%. That is lower than 5% of the straight bond of Siam Cement Company. Siam Cement can defer or delay the dilution effect as the second advantage here. The dilutions will happen when investor convert the convertible bond to stock equity. For example, here, the example 1. A company issue a 5-year convertible bond with a face value of 1,000 and promise to pay coupon 3.5% per annum and a conversion price of 50 per share. If I asked you for the scenario 1 here, if the stock price, I mean the price of that company going up or rise to 60, what should you do? Here, in this case, if the stock price rise to 60, the investor should convert the bond. The bond would give the investor share what that is the 1,200 baht. The example 2 of the convertible bond. A company issue a convertible bond 3 years with a face value of 1,000, coupon 3.5% per annum, and a conversion price of 50, right? The same. But in this case, for the scenario 2, if the stock price less than 50 baht, what should the investor do? Here, this is on the opposite side of the example of the previous example, that is the example 1. That is the if the stock price less than 50, the investor should not convert the bond. Then the investor should hold the bond and receive 3.5% per annum until end of year 3. When you invest in the corporate bond, you need to know the risks of that bond, right? How to measure risks of corporate bond? What do you think? So here the credit rating of each bond can indicate the quality of each bond. For example, here, Moody's, S&P, Fitch, and Twitch are the credit rating agency who provide credit rating of any bonds. The higher credit rating that is triple B. Triple B is the B, B, and B, right? The higher credit rating that is triple B and above suggests lower credit risks. On the opposite side, the lower credit rating that is double B or below indicate higher risks. The lower credit rating bond tentatively pay higher coupon compiling higher credit rating in order to compensate higher risks. As I mentioned in the previous slide that the corporate bonds are riskier than government bond, right? How we know the level of risk of each corporate bond? The bond rating will support the information for investor for decisions to select the corporate bond. On this slide, you can notice that there are two main types of the grading of the bond. The bond rating on your left-hand side are investment grade bond, but on your right-hand side are non-investment grade bond. The other words of non-investment grade bond are high-yield bond or junk bond. The investment grade bond run right from the triple A, double A plus. You need to pay attention to what I'm saying after this. I suggest you memorize that the investment grade bond should have bond rating at least triple B minus. The investment grade or or higher rating. What is the investment grade bond? An investment grade bond refers to the bond rated triple B minus or better. This bond contains lower risks or default related to the non-investment grade bond. And because of the investment grade bond contain lower risks, this bond tentatively pay lower interest or lower return comparing with the non-investment grade bond. Here is the characteristic of the investment grade bond. We move to here non-investment grade bond or lower rating bond. On the opposite side of the investment grade bond, the non-investment grade or high yield or junk bond refer to bond rated double B plus and lower. The high yield bond contain riskier than investment grade bond, and because the high yield bond contain high risk as a result, this bond tentatively pay higher return, right, or higher interest rate comparing with the investment grade bond. So for now, we completed the debt security or fixed income security. We then move to the equity security. On the slide number 38, I provide you the comparisons in terms of the characteristic of the government bonds and corporate bonds. Here you are, we move to the equity security. There are three main types of equity security here that are common stock equity, preferred stock, and stock warrants. Firstly, what is common stock or the stock equity? The key message that I want to share you the idea that is the common stock is a security that represents ownership in a company, while fixed income or debt security represent as debtor. When you invest in the stock, common stock or the stock equity, your status, you are the one part of the ownership in that company that you invest. The characteristic of common stock are here. Investors who invest in common stock are shareholders of the company. There are two main returns that the investor or shareholder will earn or get from investing in common stock. The two main returns are firstly dividend and secondly capital gain or capital loss. However, as the shareholder, the dividend that the investor tentatively earn could be changed or eliminated. It means that the dividend that the investor will get is not a fixed amount. It's not a fixed income, right? Dividend is not the fixed amount to pay to the investor. It depends on the performance of the company. And the main characteristic of common stock shareholder is that the investor have voting right. Please compare the characteristic of common stock to here, the preferred stock. What is preferred stock? Preferred stock here is a type of equity security as well, but the preferred stock do not have the right for voting. I mean, if you hold or if you invest in the preferred stock, you didn't have the right for voting, but the return that the investor can earn from investing in the preferred stock is dividend. The dividend from preferred stock, they will pay you, right, the amount that the company will pay the dividend to preferred stock will be fixed. It doesn't matter the profit or loss of that company, but the company need to pay the fixed rate or fixed amount to the preferred stockholder. On the slide number 45, I share you the comparisons between common stock equity and preferred stock. The last type of equity security is warrants. Warrants are a kind of derivative and give the investor the right to buy a common stock of the company at a specific price and at a specific date. A warrant is issued directly by the company. The other company or institutions cannot issue the stock warrant. Example 3, that is the warrant. Here, in terms of warrant, in the case of Siam Cement, issue warrant and offer to shareholder. Each warrant allows shareholder to buy one share of SCC at an exercise price of 200 baht per share. The warrants are valid for 5 years from the date of issuance. Derivative security. What are derivative securities? Derivative securities are financial contracts whose value is derived from the performance of an underlying asset, index, or interest rate. Here, the derivative security is the financial contract, right? The value of derivative security is depend on the other underlying asset. For example of underlying asset here, for such as bonds, stocks, commodities, currency, or interest rate. The characteristic of derivative instrument. The derivative security is a kind of the contract, right? As I mentioned in the previous slide, that the value of the derivative security is depend on the value of another underlying asset. Can you imagine, please follow me, that for example, the value of the derivative security depend on the value of the index. For example, like I said, index, SET, right? SET stands for the Stock Exchange of Thailand Index, or depend on the value of any single stock, like for example, Advanced Info Service, Siam Cement, PTT, or depend on the price of precious metal like gold or silver. As I mentioned that the derivative security is contract that include future contract, option contract, etc. The purpose of investing in derivative security. Derivative security are used for a variety of purposes, including risk management, speculation, and arbitrage. At this stage, we will discuss on the organized derivative instruments that are future and options. What are the future? The future are derivative financial contracts that obligate both two parties. Two parties is meant both of the buyer and seller. I mean that the buyer and the seller need to have to or must buy or must sell the asset on the maturity date at the fixed price. The main characteristic of future is the obligation of two parties, both the buyer and the seller, to buy and sell those assets at fixed price. On the slide number 55, show you example of future contracts in the stock exchange of Thailand, such as Z50 future, single stock future, rubber future, gold future, USD futures. Options. What are the options? What do you think? Here an option is a kind of derivative security, but the option provides the buyer the right, not obligation like future. If you buy the option, you have the right to buy or not buy. As well, if you buy the option to sell, you have the right to sell or not sell the underlying asset. But if you sell the options, if you sell the options to buy or if you sell the option to sell the underlying asset, you're obligated to buy or sell the underlying asset at the fixed price. Type of options. There are two types of options. The American style option can be exercised at any time prior to their expirations. However, for the European style options, you can only be exercised the option on the expiration date only. The basic type of option contract. In terms of type of option, there are two types of option that are call options and put option. What is call option? Call option gives the buyer the right, not the obligation, to buy the underlying asset at the exercise price that specified in the option contract. At the same time, put option gives the buyer the right, not the obligation, to sell the underlying asset at the exercise price that specified in the option contract. On the slide number 60, I show you example of set index option in the stock exchange of Thailand. That's all. I would love to share students the knowledge about the financial security.